How to adjust your strategy based on skew. Have you ever wondered how to adjust your trading strategy based on skew? Understanding volatility skew is essential for options trading. It refers to the uneven distribution of implied volatility across different strike prices and expiration dates. This knowledge can help you maximize profits and manage risk effectively. First, let's clarify what implied volatility is. It represents the market's expectation of future price movements of the underlying asset. This is a critical factor in options pricing. Now, volatility skew occurs when implied volatility varies across different strike prices. Typically, out-of-the-money options have higher implied volatility than at-the-money options. There are different types of skew to be aware of. A negative skew is often seen in stock options. Here, downside strikes, like out-of-the-money puts, have higher implied volatility than upside strikes. This indicates a greater fear of market downturns. On the other hand, a positive skew is less common but can happen when upside strikes have higher implied volatility, suggesting a bullish sentiment. You might also encounter a volatility smile. This occurs when both out-of-the-money and in-the-money options have higher implied volatility than at-the-money options, creating a smile shape on a graph. Now, how can you adjust your strategies based on the skew? In a negative skew environment, buying out-of-the-money puts for downside protection can be more expensive. This is due to the higher implied volatility. To offset this cost, consider selling out-of-the-money calls, which usually have lower implied volatility. For speculative strategies, you can buy options with low implied volatility while selling those with high implied volatility. For example, if you expect the skew to normalize, you might buy at-the-money options and sell out-of-the-money options. Earnings announcements are another important factor. During these events, volatility often increases and skew can become more pronounced. If you anticipate large price movements, you may want to buy options with higher implied volatility. Risk management is also vital. Understanding skew helps you identify mispriced options. If the skew suggests that out-of-the-money puts are overpriced, you might want to avoid buying them unless absolutely necessary. In practical terms, you can use option spreads like iron condors or butterfly spreads to take advantage of skew. These strategies involve buying and selling options with different strike prices and volatilities. Another option is a collar strategy, where you buy out-of-the-money puts and sell out-of-the-money calls. This provides downside protection while limiting upside potential. However, adjust this strategy based on skew to avoid overpaying for protection. Incorporating volatility skew into your trading strategy can help you navigate the options market more effectively. By understanding how skew affects option prices, you can make informed decisions about when to buy or sell options. This approach can ultimately improve your risk management and potential returns.